In about 12 minutes, the bells are going to ring and trading will start. And our next guest warns of speculative froth in the commodity markets. To get her take on what investors should do about it, Diana Avigdor, portfolio manager and head of trading at Barometer Capital, joins us now. Good morning, Diana.
Good morning.
Talking about speculative froth, a lot of people would say that that froth has been eliminated with the correction we've seen just over the last couple of weeks. Do you agree with that, or you see more pullback?
What a bad day to go against the Goldman call that everybody is talking about. To be fair, they downgraded the commodities a month ago, and now they've gone positive. You know, my angle on the commodities is that it is now an exposure. You can get exposed as just as an asset class. It used to be equities, bonds, and to a lesser extent foreign exchange. And the stocks that you bought that were commodity driven were still just the equities. Now there's a whole new asset class, just directly commodities, where people and not just institutional managers or people that are in a business of commodities, of oil, imports, exports, that sort of thing. Anyone can invest in this. So through that, there's really been a huge increase in trading this sector, as you could see by the volumes. And I'm not the only one who thought so. The margin requirements that were increased over the last few weeks have shown you that the authorities also thought that that was required in order, and it burst a little bit of the bubble. Whether it continues to go on or not, it's really going to depend on the macro environment. It is also a proxy for economic growth, and as long as economic growth continues and we continue to correct our economies, 2 steps forward, 1 step back, and perhaps we're through the 1 step back now, I think it's going to keep on going as long as we have China growing, as long as we have India growing, as long as we have emerging markets, despite the correction that we've been having in the last few weeks. It is entirely possible, from my perspective, that there is further sloppiness ahead for several macro and micro reasons.
Well, the sloppiness in the commodities, maybe a lot more volatility. What about the companies that a lot of Canadian investors want to think about? Are there opportunities there because they haven't tracked the froth to the same extent?
That's right. I heard it. I was talking to a trader, and this sentence stood out in my mind as exhibiting the market characteristics right now. The market is driven by sentiment, positioning, and currency flows, and the fundamentals have been left for academics right now. You and I have been talking about equity correlations in past interviews. Equity correlations have gone from low 20s to about 31% the last 2 weeks. They've increased. What that means that all stocks are exhibiting market characteristics. In other words, it's the macro that's driving the stocks, not their own fundamental characteristics.
So Diana, isn't that an opportunity then?
You know, that's a sentiment of higher risk coming on.
Okay.
The options market is pricing in a 56% correlation. That's about 20 plus points higher than the existing correlations, which tells you that traders are expecting those correlations to continue to rise for macro reasons.
And one of the things you're looking at, a lot of traders do and technical analysts do, the 200-day moving average. In most cases, I just looked at the S&P 500 and the S&P TSX. We're a long way from the 200. Could we get down there?
So we could perfectly well get down there, and from a technical perspective, every technician is going to tell you we're in an uptrend long term, but given the rally that we've had in the last few months, it's not entirely unthinkable that we're going to have a little bit of a correction. It's seasonally the right time. And I'll also bring up another statistic that, another data point that we look at in our data model. We look at the number of stocks that are trading above their 200-day moving average. And a few weeks ago, a little over a month ago, it hit 80%. Meant that 80% of the stocks that in that universe were trading above their 200-day moving average. That number has now dropped to below 60%. And in the last 40 years, 16 out of 17 times that model broke the 60% point went to 40% and often even lower. So anchoring this in the context of the recent rally, there's no reason that we cannot go through a period of sloppiness going in from a short-term tactical perspective.
And so, Diana, what do? Do we sit on our hands, or do we start a buy list and just wait for things to come to us?
You build a farm list of stocks that you like. As a short-term trader, you sell your rallies. And if you're an institutional trader or any other trader that's looking to sell something, if you get the liquidity opportunity, you go ahead.
Okay. And just a final question, ma'am. Banks, are people positioning for a good bank reporting season or a bad one?
So I think that money is rotating. I've seen money rotating into the financials. We're expecting a decent quarter. The first quarter of the year should have been good for the likes of Royal Bank. We're looking for their capital investment division to do well. We're looking for increases in dividends, National Bank primarily. So yeah, we're expecting a decent quarter from the financials, and I hope they trade well on that.
I hope they live up to it as well, Diana. Thanks for joining us this morning.
Thanks for having me.
Diana Avigdor, Portfolio Manager and Head of Trading at Barometer